Hey everybody, this is Scott Arnell and welcome to this episode of SRI 360, where in every episode I interview world-class sustainable and responsible investors, executives, or entrepreneurs who are driving positive change in the world while achieving market returns. And I do this to bring you the lessons that they've learned along the way from their investment activities and their experiences, so you can find out what they are actually doing and how they're doing it, so that you can have better insights into the different SRI investing strategies that are actually being done today and across many different asset classes, and hopefully in order to help you invest in a more purposeful way and to invest for positive impact and for a better world through your investment activities. So today I am speaking with Alina Donets, and Alina is a globally recognized specialist in water and sustainable investment, which is this whole biodiversity discussion, which is an area of the investment world that somehow I just never ended up dealing with over the years. I didn't know very much about it, so this interview was as interesting for me as it will be for anybody. Alina is the lead portfolio manager of LO Funds Natural Capital at Lombard Odier Investment Managers, and she is based in London. The fund invests in publicly listed companies that contribute to the preservation of natural capital or create solutions for the circular biodiversity economy. Alina launched this fund in 2020, and it already has over $900 million in assets under management. Alina has been managing sustainability portfolios for more than 8 years, and prior to joining Lombard Odier, she co-managed Allianz Global Water strategy at Allianz Global Investors in London. Alina has a very interesting educational background. She speaks a number of languages. She was born in what is now known and what we all hope will continue to be known as the Ukraine. We will discuss how she switched from studying the premium brands of Paris to visiting waste management facilities in Geneva. We will delve into the definition of natural capital to make sure that I was clear about exactly what we're talking about when we say natural capital, and the objectives of the LO Fund's natural capital, and we'll speak about what it means to build a high conviction portfolio and what people mean when they speak about planetary boundaries. And we'll spend some time speaking about a couple of acronyms that Lombard Odier uses to describe the old wasteful economic model versus the new circular and clean economic model that Alina is investing in. I really look forward to having this conversation about natural capital with Alina, and I think you will enjoy it too. And now, please meet Alina Donets.
So I am a portfolio manager at Lombard Odier, and as a lead and the only portfolio manager on our fund called Natural Capital that we have launched back in mid-November 2020. This implies that my day-to-day responsibilities are constructing a portfolio, which is a high conviction portfolio of 40 to 50 companies that are publicly listed that either contribute to preservation and protection of natural capital or create solutions based on the bioeconomy or based on nature itself. So in a sense, harnessing the nature. Of course, that it doesn't stop at selecting the companies, because the team is quite small and we're growing and we have big ambitions. So my contributions to the company would extend beyond just a simple stock selection. We do a lot of engagement work. We organize a lot of our capabilities around the ESG integration as well. We're working on streamlining and developing our reporting. So there's a lot of contribution to the overall improvement in our approach to sustainability, but that all is also aligned and positively contributing to the positioning and the capabilities of the Natural Capital Fund itself.
Maybe before we get into all of that, I guess I'd like to chat briefly about your background. So if I'm right, if what's on the internet is right, you're born and raised in Czech Republic, is that right?
No, actually, no. So I was born back at the time when the area where I was born was still USSR. But my original origins, the way I would name them, is Ukraine. So I was born in Ukraine, and we lived in Ukraine up until I was 11 years old. And then my parents made a decision that they would prefer to have better standards of living. So my father was an entrepreneur. He wrapped up, he sold his business, and we moved to Czech Republic. So 99, both of my parents live in Czech Republic. And so when I moved, I transitioned first to Russian speaking or Russian language school because my first language is Russian. Spent a couple of years there and learned Czech. And then I went to Czech school. I finished my secondary education and then I went to English college in Prague to get international baccalaureate with an objective to then continue my university studies in the UK, which I did.
Yeah.
I moved to London. I did my bachelor's here. I already started interning with some of the financial institutions while I was doing my bachelor's. So I started with macroeconomic research, went into equity sell-side research, and then eventually I decided to do my master's as well. So I did my master's in Paris.
Yeah.
So here in the UK, I did the bachelor's at Cass Business School, master's at Accusations in Paris, and then eventually.
Do you speak? Sorry to interrupt. Do you speak French?
I tend to say that I speak 3.5 languages, and the French is the half.
But I should say everything's done in French there, no? Or not?
No, so my program was fully in English.
Okay.
I did have exposure to French, but I think that the biggest part of my French actually came later in my life when I spent 4 years living in Geneva.
Yeah.
There it's very difficult to go without French.
Okay, so I'm going to stop you again. So if I understand, your formative years, you grew up in what's now Ukraine, is that right?
That's correct.
Yeah, and then you moved to Czech Republic, what year?
In 99.
99. Wow, so you, man, a lot of changes going on in all those countries in the 90s, huh? What was that like?
I was very young to be able to perceive any political nuances or political changes. But I think it was a very difficult experience back then because especially the move from Ukraine to Czech Republic has been culturally very sensitive. You might remember that actually Czech Republic has been occupied by USSR for quite some time. So there was a lot of personal negative feelings or negative perceptions of people coming from the USSR or post-Soviet countries. So the integration into the local community was very, very difficult. And I remember as a child suffering quite a lot. And I actually think that we have never fully integrated. So there's still my parents living there, have their own community. Yes, they do have some local friends and kind of local connections, but we have never been able to integrate culturally. It's a very distant culture to us. So that was very challenging. I think it affected me on a personal level in many ways, but equally, I also think that this kind of experiences give you a reason perhaps to try harder and an opportunity to focus on yourself and really understand yourself much better and create certain aspirations that you can follow then as an individual. While I remember the times and I remember how difficult it was, I would never regret that experience because it was a learning opportunity.
Yeah. So then fast forward after you got, freshly minted Masters of International Business from Accusations in your hand, and then you decided that you're going to set off for that nerve center of the financial world, that citadel for the bright lights of Geneva, Switzerland. Which
Not yet, actually. When I finished my master's, I wanted to come back to London, which I did. So I actually started as a graduate trainee with Pictet Asset Management in London. It was a very focused program. They were traditionally hiring only 2 graduates per year to work in the equity department of the asset management firm. And I was actually, the year when I joined, I was the only graduate that they hired. So it was a pretty exceptional opportunity. And the program works, or the program lasts for 12 months. I actually ended up doing it for 13 months because of some travel that was combined with that. But for 12 months, you're meant to rotate between different equity investment teams. So it's really focused on the equity investments and asset management arm. And I spent quite a lot of time in Geneva. So I spent about 2.5 months in Geneva working with the thematic team, and then another almost a month in Zurich working with some of the teams based there. So I had an opportunity to learn different approaches from systematic to emerging markets to thematic, which was obviously a very different approach to investment. And I was very excited about thematic investing. And obviously as a young investor, it sounds all very sexy and very innovative, and there's a nice story to tell. So I was very keen to actually join the team. And to be frank, the water fund was not my first choice. I had a very strong preference for the digital communications, which was obviously even more dynamic area of investment. But there was a need for somebody to join the water fund. And I did. And I remember so at that time, that was the decision a year after I finished my master's to move to Geneva to join the water fund. And I remember a couple of months later, I would be, maybe not a couple of months, maybe within a year after that, I would be going around this huge manufacturing floors or industrial conglomerates that we would invest in, or go to the waste management facilities in the US to understand how the businesses work and gain some information and insights from the grounds. And I would be walking around and feeling the smell of the waste and wastewater treatment facilities and thinking to myself, how did I switch from studying the premium brands in Paris?
I've had some of those moments myself, yeah. I've had some of the exact moments like that. And then you went from Pictet to Allianz as a portfolio manager on the Global Water Fund. So right away, I'm starting to see you were the water woman.
Yes, I was. So when I joined Pictet on the water fund, I did do some more work. I was actually back then working on supporting the development and the launch of the Global Environmental Opportunities Fund at Pictet. But I was always considered to be a dedicated person on the water fund. And then there came a time when I decided that I wanted to come back to London, and through a lot of different discussions and through exploring my options both internally and externally, I found this amazing opportunity to join Andreas Pruschke at Allianz Global Investors, which was a great opportunity for me because it was a much smaller team. Andreas was only at the very early start of his aspiration for developing a thematic hub within Allianz Global Investors. Back at the time when I was joining, he was running already the water fund for quite some time, and he just launched a multi-thematic fund, and he wanted to expand. He wanted new ideas. He wanted to grow the team. And I was coming with experiences from the thematic leader. And I had a lot of my aspirations to apply this knowledge that I have gathered. So we were very aligned in these aspirations and goals and career ambitions. And for me, eventually, as I found out, it wasn't just me coming in and sharing my experiences in thematic investing, but eventually I found a huge source of knowledge and expertise on sustainability, ESG investing, SRI approach from Allianz Global Investors, because the company by then has already had really multi-year experiences, a very big structure around sustainability investing, not necessarily yet fully developed, but already containing a lot of information that we then also used to continue developing the product line.
Yeah. Was it impact focus or was it broader? It was broader than that.
So when I joined Allianz, we started positioning the water fund as potentially an impact strategy. And this is when the conversations internally started. And we have gone through almost 2 years of very rigorous approach of assessing what is the best way to approach sustainable investing. How do we categorize different funds? Because there's obviously a wide area of different investment processes. And on top of that, you also have to consider the differences between different asset classes. And Allianz being such a huge organization and with such a big reliance on kind of global reputation and risk management, that we really needed to make sure that everything is consistent and we have the best approach to the wide area of sustainable investments. And so maybe a year and a half into my journey with Allianz, we have actually, and I have been a strong proponent of actually impact investing in public equity. But there was understandably a lot of resistance, because once you call yourself impact, you sign up to actually delivering on certain objectives, being able to measure, to quantify, to create a direct link between your investments and impact. And eventually we made a decision to differentiate or categorize the investments differently. So we had the SRI, which is best in class and minimum exclusion. We had the ESG, which is ESG integration, so monitoring your risks. And then we had, on the positive side, we had impact investing for direct investments and green bonds. And we had what we eventually called SDG-aligned and sustainability-themed products that would consider environmental and social objectives as objectives of the investments. But we would not be able to call it impact because we would not be able to fully quantify the impact.
Yeah, I'd like today to try to understand what the Lombard Odier Natural Capital Fund strategy does. Yeah, you could help me start this by giving me an easy to understand definition for natural capital, since we've already used the term a bit here, because I want to make sure I know what you mean by it. And then maybe you could follow up by giving me a high-level introduction to the Lombard Odier Natural Capital Fund.
No, I think it's all very fair questions, and it is the right place to start when you're trying to understand the objectives of the fund and the scope of the investments. So when we talk about natural capital, it's basically all the resources that we get from nature, starting with the non-renewable resources, such as, for example, the minerals that we abstract from nature or other materials that we then transform and utilize in our economy and society, to also renewable and regenerative sources that we utilize either as direct inputs, such as, for example, water, or as a service or an enabler of certain activities, such as, for example, bees that pollinate the agricultural fields that eventually enables us to feed the population. So it's really the aggregation of all the resources in nature. Now, why do we need to consider investing in these resources? So I think there are two key parameters or two key factors that you need to consider. First of all, it is estimated that over half of the global GDP directly relies on natural capital or natural resources, be it in the form of physical resources or the services. That means that as a population, we are reliant on nature for our living, and our economy is very tightly reliant on the natural resources. Now, at the same time, what happens is that we are not utilizing these resources efficiently and effectively. So we are over-abstracting or overusing these resources, which then leads to us creating negative externalities to the planet. So it can be by either utilizing or abstracting the resources quicker than they can replenish themselves, or equally just creating negative externalities such as pollution that then eventually harm the natural resources, the nature, and therefore reduce its efficiency and resourcefulness. Now, this whole, if you think about the concepts and the understanding of sustainability globally, this is all still quite a relatively new concept. So we have already seen over the last decade or maybe 2 decades an improved understanding of the climate change, the reasons behind it, and the long-term consequences that eventually translated into willingness to do something about it and address it. Now, when it comes to natural capital, it's much broader. It's equally as important, and it is equally as challenged, but there isn't yet a fully aligned consensus on what needs to be done and how to do it. So one of the theories that we like to consider, and actually it's a theory and the framework around which we're hoping to build measurement tools that will allow us to also quantify the risks and the positive impact, is the framework of planetary boundaries, because it allows you to monitor and assess where do we stand in terms of utilization or footprint on some of these natural resources relative to what is a sustainable manner of utilizing the resources. So we use it as a framework that helps to support and perhaps organize some of the thinking, but this is not a proprietary tool. As opposed to that, we have developed a proprietary tool at Lombard that helps us to translate this whole theory and the concept of the issues around the sustainability, the planet and the way we manage and address resources, the way we operate as a human society, into investable opportunities. And we did that through the concept that you have also referred to when we spoke before this call, which is the CLIC methodology. And we can definitely talk about that, because that's the starting point on which we have mapped or established the key objectives of the investments that need to be undertaken in order to address certain challenges.
Right. Let me quickly add, you mentioned planetary boundaries. What does that mean?
So planetary boundaries is a theory developed around the capabilities of the planet and the certain levels of be it biodiversity, be it chemical content in the planet or in natural resources that keeps the ecosystems and the planet functioning at an equilibrium. And so what we have already recognized that is, for example, the nitrogen and phosphorus pollution stemming from the agricultural activities has already increased to levels where it has significant impact on biodiversity. So we exceeded the limits of the planet to actually absorb and manage or self-regenerate some of these consequences. And there is a number of other metrics that are being monitored and being assessed. And the problem is that we are not integrating this into the investment decision making when it comes to the operations and when it comes to global policies and global behavior of either the economies or the population. And therefore, we're still at the point where a lot of this remains unaddressed.
Right. So what's the AUM right now?
So we're over 640 million assets under management, and we are, as of today, we're actually exactly 5 months old.
Okay. Wow. And then you mentioned something earlier that it's a high conviction portfolio. All I could afford was a public school education, and that's in the American sense. So you got to help me out here. What can you explain high conviction portfolio?
Yeah, we try to be quite concentrated in our investments. So traditionally, when you go in public investing, especially for broader diversified funds that invest in global equity or perhaps have a regional or style biases, you would see anywhere between, let's say, 60 to 100 companies invested in the portfolio. Now, we actually try to build a conviction, meaning that we want to understand the businesses bottom up. We want to be really persuaded and convinced that these are the right businesses from the perspective of the sustainability contribution, as well as just financially sound and attractive investment opportunities. So given that we pay such a close attention to this, we want to construct a portfolio consisting out of 40 to 50 companies. So quite concentrated, where really we would have a very detailed and rigorous view on each of the holdings in the portfolio.
Okay, I got it. And do you have what is the term that you plan to or target to hold these companies?
So our turnover would be anywhere between 30 to 40%, which means that on average, we'll probably hold a company for 3 or maybe just under 3 years.
How did you arrive at that?
It's just historically what I am used to. So our investment horizon is actually much longer than that, because in the sustainability space, the positive contributions and the kind of the outcomes of the focus of the company are such long-term and so secular and fundamental, that you usually, as a thematic or sustainable investor, you end up looking far beyond the horizon of traditional market participants. So when you're assessing this investment cases and you have a certain view on, for example, the environmental benefits of a product portfolio that you think are going to be benefiting this company because you see the regulation changing or you see the needs of this technology to be adopted, you have a much longer view, and so therefore sometimes it takes longer until the other market participants actually recognize what you have seen before they did. And so eventually you end up holding the company for close to those 3 years just to wait until your investment conviction or your investment assumption has finally materialized and priced itself effectively in the market.
What do you benchmark against?
I would say we're benchmark agnostic, but of course our conviction is that investing in companies that create solutions to natural capital is more attractive financially, not just from the sustainability objectives, and therefore we would expect to outperform the market. Now, we also have a focus on smaller to medium market capitalization companies. So our reference benchmark would be MSCI All Country World Small, what we call SMID, so small to medium capital market capitalization company.
Now, your fund's philosophy, and correct me if I got this wrong, you want to basically drive the transition from what you call a wild economy, and wild is an acronym that stands for wasteful, idle, lopsided, and dirty, to the CLIC economy you mentioned, which is an acronym for circular, lean, inclusive, and clean. And just this morning, I was having coffee with my wife, and I said, you know what we're missing? We need more acronyms in the financial industry business. So can you explain WILD and CLIC?
So WILD and CLIC are actually the framework that we have developed for the range of our investment solutions, not specifically for natural capital. So natural capital only sits as, or only became to represent part of this investment framework. What we mean by wild is basically the traditional approach to a linear business or a linear economic model, where you take the resources, you make products, and then you waste the resources because once you've utilized that, you dispose of it. Now, what we need to create is a certain level of circularity. So the circular part of the CLIC allows for capturing that transition from linear business models to circular business models. But that's only part of the CLIC concept, WILD and CLIC concept. Another part of it is, for example, dirty. So as a humanity, we have been creating a lot of pollution, and one of the key challenges with pollution that we're currently globally facing and globally addressing is, for example, carbon emissions. So within that, we need to transition from the dirty economy to clean economy, which is another part of the CLIC concept. And that we would do, for example, with our climate transition fund that targets to invest in companies that first develop the solutions to carbon emissions, and secondly also are helping to transition the economic systems into lower carbon emissions. So really the WILD concept represents the traditional approach that we have lived with for centuries as a humanity, and CLIC represents the number of targets that we as a company think are essential to achieve when it comes to sustainable investing. And then along the clean, lean, inclusive, and clean, circular, circular, lean, inclusive, and clean, along those you develop investment solutions that help to address these challenges.
I'm glad you did that, not me. So is that the difference between the climate fund? Is that's more technology based?
No, so we're both investing in companies that develop technologies, but we are addressing different challenges within the CLIC framework. Climate Transition Fund invests in solutions that help to solve the climate challenge, so addressing the carbon emission issues and helping to build resilience to the climate change. In natural capital, I'm actually addressing the issue of circularity and lean operations. So I am not investing in climate-related transition. I'm not investing in reducing carbon emissions. I'm investing in companies that would create a more lean utilization of resources during the manufacturing process, or that would create closed loop systems in waste management practices, or eventually maybe create biologically based solutions that help to replace some of the chemicals that we're currently utilizing in our production.
And the devil's in the details. How do you actually do this and integrate this theory into a listed equity strategy and get down to what you do, which is selecting your portfolio shares?
Starting with the beginning, or starting with building the investable universe and the opportunity set for the fund. So as I mentioned, we are targeting the circularity and lean practices with the natural capital fund. That means that we're transitioning from the linear economic model to a circular economic model. And we like to think about it in form or in the shape of a butterfly. So what is happening is that in the middle of the economic foundation, you have the linear model, which is abstracting resources, processing them and creating goods, and then eventually these goods are being consumed and disposed of. Now, what we want to do is we want to make this body of the economy leaner, which stands for the first acronym. That means that we need to target industrial processes to increase the efficiency with which we utilize the resources, meaning use less of resources to create the same amount of goods, as well as we need to make leaner consumption activity, which means that we need to increase the utilization rates of the products that we have produced in the economy, because a lot of them actually go wasted or idle. That's number one focus. Then at the same time, of course, while we're trying to minimize the amount of resources that we're utilizing in production and we're trying to optimize the consumption, some of it eventually comes to the end of its life. And so we need to make sure that we reuse this waste and we close the loop by creating a closed loop system. So that's one wing of the butterfly. So we have gone through slimming the body and recycling part of the waste, or the bigger or the maximum amount of waste back into the economy, so we can reutilize instead of abstracting more from nature. And then the second part of the second wing of the butterfly is actually, can we substitute some of these resources that are non-renewable with resources that have self-regenerative features? So can we use nature as a resource in a more effective and sustainable manner? And an example of that could be, why don't we substitute plastic with paper, where actually paper has a self-regenerative features. It's much easier to recircle back in the economy and reutilize that product. But equally, it creates much less harm. And actually, if you have the right production process, it creates positive externalities along the production process. Stemming from that philosophical approach to what we need to do with the economy and the society, we have actually identified the 4 key areas for investment. So we have the circular bioeconomy, which is one of the wings. We have lean industrial processes. We have outcome-oriented economy, which looks at the consumption part. And then we have the zero waste. And once you have identified those 4 key activities, or the 4 key buckets that need to be addressed and developed, the next stage is to identify the business activities that allow you to achieve these objectives. So the business activities within the bio-based or circular bioeconomy would be, for example, smart food systems, or biomaterials, or efficient management of the water resources. Within the efficient industry, you would be looking at dematerialization. You would be looking at advanced materials that help to improve the resource efficiency. Then in the outcome-based economy, you would be searching for companies that enhance the share and repair within the economy. So again, maximizing the utilization of the products that you have developed. And then finally, the zero waste is everything about collecting the waste, about processing, recycling the waste, as well as potentially reducing the waste in the food system. So it's again, the optimization and closing the loop.
Do you have any examples you could give of any companies you invested in using this methodology?
It's important to realize that all of these objectives and all of these benefits to the natural capital that this different businesses and different business activities would have are very difficult to assess. I would almost say that it's an ethically challenging question to assess which of them needs to be addressed more, right? Because it depends on a number of different factors. It depends on the cost of the technology. It depends on the necessity or the pressure that you're seeing with a certain particular issue. It also depends on how well the company, specific company within this business is able to scale the technology. So there's really a lot of points that come into consideration when you try to allocate between the companies. So instead of trying to score or create a systematic approach that will have certain objective assessment of the importance of the sustainability contributions or positive impact that we're creating, we have come to an agreement, or we have come to an assumption that all of these topics are equally important. And so actually the selection of the companies for the portfolio will be based on the conviction that we create around that specific company instead of a result of scoring of the environmental challenges. And that means that we do integrate the ability of the company to contribute to positive objectives that the product or the service that they produce can achieve. But there's a number of other factors that we need to consider, such as, for example, do financials of this company reflect the opportunity, or are they strong enough to actually bring this opportunity forward? Is this company an attractive return on investment? Is this company well managed? And this is where one of the questions that you asked about the CAR methodology also actually addresses not the environmental or social impact created by the product, but the evaluation of the footprint of the company, because we're not only investing in a company that creates positive output or positive contribution, but it also has to be a company that is managing its own footprint in an effective manner on environmental, social, and governance levels as well. So there's really a lot of different factors that need to be considered before you're making the investment decisions. So the CLIC methodology and the focus on preserving natural capital and harnessing nature really comes at the first stages when we define the opportunity, the investment opportunity set. Once we have identified that universe, which currently stands at 600 companies active in the businesses that create these positive outcomes for nature, then you start looking for the most attractive investment opportunities, assessing, of course, the technology that the companies are producing, but equally a number of other factors.
Can you give me one example of a company that you've invested in and how you got there?
So, for example, one of the investments that has been there since we launched the fund is Advanced Drainage Solutions, a company that creates solutions and systems around water drainage. And the reason why this is important for nature is the urbanization of or global urbanization and global development of the cities is actually altering the water cycle quite significantly. By creating urban areas, you're preventing the absorption of water underground, which obviously then changes the content of water in your underground space and then alters the distribution of water. Equally, the inefficient sewage or stormwater management can actually wash off a lot of pollution from the city back into the natural habitats, which can harm the biodiversity. So what you need to do is you need to create very effective sewage systems with minimum alteration of the underlying biodiversity and underlying ecosystems. So advanced drainage systems develop sophisticated systems, and they develop the products that allow for an efficient and effective implementation of these sewage systems. And then on top of that, it's one of the companies that realized the value of sustainability, not only from the perspective of the end use of their product, but also from the design of the product. Over 3/4 of the raw materials that they're using is recycled plastic. So by creating certain design of their product, they're actually helping to close the loop in the economy. So this is one of the perfect examples of a company that creates the product that has a strong positive contribution to, in this case, water resource management, and equally has created that solution on the recognition of the sustainability benefits, which actually led to a significant market share opportunity gains for them.
Back to water again, aren't we? If you had to define the natural capital strategy, maybe you don't want to or you choose not to, but if you had to, is the strategy SRI, is it ESG, is it impact, or is it something else?
I'd say it's closest to impact because we invest with a certain sustainability objective. Of course, we also want and aim to make sure that the companies we invest in are not creating any harm while generating the positive impact. So there is an ESG component to it. But because of the sustainability objective of the technologies that we're helping to finance, I think we're getting closer to impact.
Public equities are generally larger companies, right? And they often have many business activities. Some have positive, some have negative impacts, all under the same umbrella. So I guess that when you talk about impact, do public equities then practically allow for a targeted approach when in the end, these are oftentimes large companies that have a lot of different things going on?
Yeah, first of all, when it comes to the purity of the companies or the exposure of the companies to the activity that interests us, we would not invest in a company that has less than 30% of their business in the activity that has positive contribution to natural capital. I would say that on average for the fund, it's way higher than 30%. I think we're getting closer to 60-70% exposure when you look at the average fund value. And at the same time, we're not just passive investors. We don't just select companies for investment. We actually have a very active, large engagement program for natural capital where we aim to meet with the companies not only to discuss any particular issues that we might see along the environmental, social, or governance aspects, but we also want to emphasize the reasons for our investment. We want to let them know that actually we are investing in them because of the technology that they develop with this specific purpose. And we're doing that because we actually truly believe that capital allocation and effective communication can eventually translate into more effective decision-making at the corporate level as well. And having been in this space, and yes, I was investing in water, but having been in the sustainable space, I have seen through years how companies eventually start appreciating the source or the foundation of the interest of their investors and start focusing and allocating more towards the businesses that actually majority investors are interested in. So we actually think that capital allocation and active engagement eventually helps to increase the exposure to the right business activities as well.
All right. But what's your view, for example, of BP? It's an oil company, 90% of its revenue from hydrocarbons, but investing, I don't know, something like $500 million per annum into low carbon energy. I think they've got a commitment to net zero emissions by 2050. Is that, what are the signals you look for? Is that good enough for you to invest today?
Yeah, so first of all, we are not in natural capital, we're not investing in climate transition, right? So a company that is developing technology for renewable energy is not part of the scope of my particular fund. I would say that there isn't the right or wrong answer. So specifically for natural capital, we are investing in technology developers. We're not necessarily investing in companies that are adjusting their practices in order to meet certain objectives. But that doesn't mean that it's the only right way. So I think what is important is for the clients or the asset owners to define for themselves what is their objective. Do they want to minimize the risks and minimize the harm, or do they want to finance solutions? So in my case, I'm not going to talk about BP because it's not part of our investment universe, but conceptually, if the company tries to minimize the harm on part of the business that is not creating positive outcomes, and then at the same time, over 30% of its business activities are actually proactively creating positive outcomes, it's definitely an interesting company to consider, because the company has realized the potential, has recognized the sustainability challenges, and it's in the middle of transformation of its business model and business proposition. Now, as I mentioned, the parameters on which you assess the attractiveness of investment are much broader than just the sustainability objectives.
Are there inherent risks and downside to investors in the Lombard Odier Natural Capital Fund? Obviously, there's shared risks with the overall equity market, but is there any other risks associated with your fund that's unique or specific to the natural capital element?
Of course, we are exposed to a number of potential sources of risk. First of all, as you mentioned, there is a financial market risk. The expectations of certain investment outcomes are not always met, and the market can have its impact on the behavior of the portfolio as well. Equally, part of the investment cases or part of the portfolio will be exposed to different types of regulation. And of course, the regulatory changes are not always easy to predict. So in cases where those regulatory changes are going to have some material impact on the businesses, it can have an impact on the performance or the outcomes of the fund. Equally, there are certain risks around just the integration, for example, of the stewardship practices or the ESG evaluations. So I think that no one can actually completely isolate themselves from the potential risks. It always boils down to having a rigorous process, large teams that would be helping and supporting these processes, which I believe we have at Lombard Odier. So we do have equity research teams, we have risk management teams, we have an ESG team, we have sustainability research team. Having the processes and a diversified and solid framework that helps to manage and reduce the risks is very important. And then eventually, of course, there is also just the balancing of the portfolio and the portfolio construction part, where again, we're trying to minimize the risks by trying to maximize the diversification within the fund. We are trying to minimize the style biases and the sector biases that we would have in the fund, and really isolate the specific drivers behind our conviction in the investments as much as possible.
Now the $64 million question, I got to touch on greenwashing. Everyone's heard the term many times, but can you explain what is it as it pertains particularly to the SRI public equity strategy space, and then how it would pertain specifically to natural capital, and how do you deal with it?
Greenwashing is never going to go completely away. There is always a component, not only in sustainable and SRI investments, but in any investment promises or any promises that people do to each other. There's always a component of misunderstanding. There's always a component of explaining your objectives, perhaps in a not very correct way, or not in a not very precise way. And then there's a potential issue with actually meeting the objectives and meeting the processes, the promises, giving the lax and subjective approach to the investment process and the assessment of some of the sustainability metrics. So I think that greenwashing is there to stay. What it means for the sustainable investment society and for people like ourselves who truly believe in sustainability and try to create strategies that would have such rigorous processes and would meet the expectations and align with the promises that we make to our clients. The challenge is that it's very difficult from the client perspective to really evaluate the consistency between the promises and communication and the actual implementation of different strategies. What could I recommend? We are already moving towards in the direction of increased transparency and increased regulation. Here in Europe, for example, just less than a month ago, we have finally had the launch of the new regulation around the way that the sustainability funds need to communicate their objectives of the fund and the scope of the implementation of the sustainability measurements and sustainability factors in their portfolios in order to align the industry and in order to increase the transparency on the processes and the outcomes of the investment decisions. I think it will continue and it will definitely support the improvement on the greenwashing side. But at the end of the day, every investor and every asset owner needs to really understand their own objectives, their own preferences, and do a very rigorous due diligence on the asset managers and investors that they would entrust their money with. There's no other way or no better way.
Yeah, but so the temptations are always going to be there.
I think the problematic of the space is the lack of objective measurability and objective tracing of the quality. There's a lot of subjectivity, there's a lot of different approaches, and the corporates themselves are not only not reporting or not being transparent enough, sometimes they don't have that transparency themselves. So they would not be able to provide the full set of data or information that can support the sustainability claims. So because the system is so complex, there is quite a lot of subjectivity and difference in opinions, and that obviously creates arbitrage opportunities for people who want to exploit it.
That's a very elegant way to say it. If you had to name the one most important challenge in the SRI public equity space at this time, what would it be?
It's transparency, because transparency on information allows for effectiveness of the capital allocation. It allows for better communication. It allows for achieving better outcomes once you know what you're doing.
What do you know now about SRI public equity investing that you wish you knew in 2012 when you showed up at Pictet?
It definitely does generate positive financial returns, which we have not believed back in 2012.
That's good. All right, so you don't have to name names, but can you describe to me an example of a stock that, you know, at the time you did your universe and your analysis and your screening, and that you were convinced at the time you invested that ticked all your boxes, but in the end it didn't turn out and it went pear-shaped? And what did you learn from that experience?
There was definitely quite a lot of companies that were where our assessment of the business opportunity and the objectives or the contribution towards preservation of nature have been correct, but the market valuation has already priced more than enough. And so we have seen over the last decade that low interest rates and the appetite for growth have translated into a certain extended valuation differences. And during the last couple of months, we have seen those differences to reverse. So it's definitely important to remember what I tried to emphasize through our interview. We're not only investing in sustainability, we're also investing in companies in the public market. And so we need to make sure that we address the financial and economical part as rigorously as the assessment of the sustainability.
Okay, and how about the converse, stock that you were skeptical of, or either at the time you invested or maybe you passed on it, and in the end it turned out to be way better than you thought, and you were pleased you invested, or you wished you had if you had passed on it? What did you learn from that experience?
I think what we're learning still now is how cyclical businesses can actually start implementing some of the sustainability challenges and as a result, reduce cyclicality. So through the pandemic, we have seen quite a number of companies that would traditionally be expected to suffer significant decline in their revenues, or perhaps that could be closed down because during the pandemic and the lockdowns, we need to restrict the social interactions. But then there was a number of companies that were producing technology that is, for example, related to water treatment, and the production sites of these companies had to maintain their operations and had to remain open because these goods are considered to be of very high importance for the wealth and human well-being. And so these are the surprising parts where actually the traditional perception of the cyclicality of the business or the commoditized nature of some of these businesses has actually not been reflected because of this positive sustainability contributions that they bring to the society.
So the last thing I'm going to ask you is, if someone wants to get into sustainable and responsible investing in the listed public equities space, how would you advise them to get into the business, and where's the best place for them to cut their teeth?
It's having the curiosity, understanding how the interaction between the sustainability challenges and the business opportunities work, because this is going to be the key driver of your eventual allocation of capital in your investment decisions. And it's not always fully transparent. There are some challenges and there are some opportunities that might be hidden. And as an investment professional, your job is to find these hidden opportunities. So I would definitely recommend, instead of the traditional approach to learning a lot about finance, try to understand try to focus on understanding the overlaps and interrelations between different parts of the human and economic activity, the long-term consequences, and how that can be eventually translated into the financial and economic performance.
All right, thanks very much.
Thank you very much, Scott.
Yeah, have a great weekend and a great first drink.
Thank you, I'll try.
Cheers.
Bye.
Bye-bye now.
If you enjoyed this podcast, please do me a favor and hit the like button and subscribe to receive future episodes. You can find more interviews, articles, and information on sustainable and responsible investing at our website, sri360.com. If you enjoyed this interview and would like to read more lessons learned from world-class SRI investors, get yourself a copy of my book, Sustainable and Responsible Investing 360 Degrees. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market rate returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 Degrees will be available wherever books are sold from July 2022, but you can pre-order your copy now on Amazon, Barnes & Noble, and Walmart.